The autumn budget just delivered 3 tax changes that could cost landlords and higher earners significantly more tax over the coming years. One of them affects property income from April 2027, and it will increase the tax due on rental profits. Another one doesn't kick in until 2029, but if you're using salary sacrifice for your pension, there are new limits you'll need to be aware of. And the third, it's a stealth tax that's already raised tens of billions through fiscal drag. And the threshold freeze now runs until 2031. I'm Henry Rutherford, Chartered Financial Planner, and in this video I'm going to break down these 3 changes and outline the key considerations for each one. As always, this is educational content and not advice. For specific advice tailored to your circumstances, please reach out to me in the link in the bio or speak with your local financial planner. Now, the first change is tax on rental profits. This is increasing from April 2027. There'll be an increase of 2% on each rate of tax. So basic rate moves from 20 to 22%, higher rate from 40 to 42, and the additional rate from 45 to 47. This applies to personally owned rental properties such as buy-to-lets, holiday lets, Airbnb and rental partnerships. It does not apply to limited companies, which are taxed under corporation tax. So what does this mean in practical terms? Well, for a higher rate taxpayer with £10,000 in rental profits, today they'll pay around £4,000. From 2027, it'll be £4,200, so an extra £200 of income tax. If the rental profits are £20,000, it's an extra £400, and rental income at £50,000 is an extra £1,000 of income tax per annum. So why is the government doing this? Well, the government notes the aim is to bring tax treatment of rental income closer in line with other unearned income. It's also expected to raise significant additional revenue. So some considerations for landlords. Rerun your rental profit calculations. Does the property still make sense? Is it still paying you enough when you consider the higher taxes, the ongoing costs and charges, and total rental yield? Is it still doing enough for you? Secondly, review your ownership structure. For some, a limited company will be more tax efficient. For others, personal ownership will still be more suitable. And the third is think about your long-term plan. The rising tax environment may influence decisions around holding, selling, or consolidating properties. So for you landlords out there, has the 2027 changes, potential changes, affected your long-term plans? Let me know in the comments. So change number 2 is the salary sacrifice pension contributions, and this is something that I've been contacted about a lot. From April 2029, only the first £2,000 of pension contributions made via salary sacrifice will qualify for national insurance savings. Employer pension contributions outside salary sacrifice are not affected. Everything above that amount still reaches your pension, it just won't benefit from the national insurance advantage. So imagine today someone sacrifices £10,000 a year. Right now, both the employee and the employer save national insurance on the full £10,000. However, from April 2029, the first 2,000 remains exactly the same. National insurance savings remain in place. However, for the remaining 8,000, or the 8,000 over and above the 2,000, there are no NI savings. The pension contributions itself is unchanged, only the NI treatment is different. So the government's stated aim here is to reduce the differences between workers who can access salary sacrifice and those who can't. So some key considerations here. Number 1 is review how much you rely on salary sacrifice. If you sacrifice large amounts, your tax position may change. Number 2 is speak with your employer. Some may adjust their contribution structure between now and 2029. And also understand the timeline. You have 4 years before this begins. It's a useful period of time to put some useful planning in place to maximise this benefit whilst it stands, but also rotate and adjust your planning for post 2029. Change number 3, the income tax thresholds will now remain frozen until April 2031. This freeze has already raised tens of billions through what we call fiscal drag, and it's affecting more people each year as wages rise while thresholds stay the same. The personal allowance remains at $12,570, higher rate sits still at $50,270, and the additional rate tax threshold stays at $125,140, all potentially frozen up until April 2031. So when earnings increase but thresholds don't, more of your income falls into higher tax bands. That's what we call fiscal drag, and it's been one of the biggest contributors to rising tax receipts. This freeze impacts most of us out there, but in particular people earning or straddling between the thresholds between £50,000 and £150,000, dual income households, business owners, anyone receiving regular pay rises, and certainly people close to the 100,000 personal allowance taper zone. These changes won't impact everyone in the same way. Your income, your business structure, your rental properties, and the way your pension is set up, all of these shape your personal position. So if you'd like help understanding how these budget changes might affect your long-term plan, feel free to get in touch. My role is simply to help you make informed decisions based on your situation. And if you found this breakdown helpful, subscribe for more UK-focused tax and financial planning updates. I'm Henry Rutherford. Thanks very much for watching, and I'll see you in the next video.